Welcome to Venture in the South. These are the stories of innovation and success in the southern U.S. that make money, have fun, and do good. This is David, and I'm here with Paul, and we're going to talk about the Angel Funders Report that was reviewed last week with one of the authors, and he presented his perspective as an author of a pretty lengthy report. It's over 50 pages. And very comprehensive 2024 summary of data from the Angel Capital Association members. So it's pretty substantial. However, Paul and I wanted to talk a little bit from our own perspective about the data, what its significance is, and how it might favorably impact individual investors and help them make decisions. So, Paul, do you want to talk a little bit about what the report covers?
Sure. Thank you, David. Good to be back on the show with you. It's been a while since we've had a Paul and David on the same show, so glad to be back in the studio with you. As you mentioned, this report came out last week, and on last Monday's episode, we had John Harbison, who's one of the authors, give his perspective on it. It is a report that collates the survey data from about 70 angel investment groups. Those groups are members of the Angel Capital Association, so tend to be the larger, more active practitioners of angel investing in a group context. And they shared their data with the ACA's data analytics team, who then produced this report. The report, as you mentioned, is pretty comprehensive. It covers a variety of things. It covers things like operational angel group management questions, size of groups and what they do, and investment decision-making and things like that. And it also covers the deals that those angel groups do. So as an individual angel, you can get a sense for how some of the more institutional or professional deployers of angel capital are behaving, and therefore maybe get a sense for how to benchmark your own individual angel investing activity against some of the leading practitioners in the space. So it's obviously a few months out of date. So it's 2024 data, but it's a pretty good survey of the activity that the larger practitioners have been doing.
I'm glad you mentioned the term benchmark, because that's how I see the principal value of this report is for individual investors to be able to benchmark their activity relative to peers across the country. Because when you're out there as an individual investor, it's often lonely and you question some of your decisions and some of your results. And so when you see your peer results, you feel a lot better that you're within 2 standard deviations of the mean. At least I do. And so that's a big part of this. I like that benchmark comparison. And so, Paul, touch on what you see as the key takeaways from this report.
Well, there are a bunch of different topics that the report covers that I find pretty interesting, but maybe just at a high level, just looking at the amount of angel investing activity in the US over the last few years is interesting. The key question is there more or is there less of it than there was 2 years ago? And the answer is clearly less. Amount of dollars of investment that have flown through these groups declined by about 37% between 2022 and 2024. Most of that happening in 2023, which was down 33%, and then another 6% on top of that over 2023 to 2024. So a pretty precipitous decline in 2 years, of continued decline, although less of one in the last year. Pretty interesting to see that through the angel groups. And I think that's probably pretty consistent with what you read from other sources of data about the amount of early stage investing getting done in the VC space and across startups in general. But interesting to see that through the data of the main practitioners.
And just to try to be as up to date as we possibly can, I wanted to review briefly the Carta data for Q1 of 2025, since that's the next set of data coming up that's not included in the Angel Funders Report, but is data that can be tracked. And so a couple things that Carta provides data on, that's deal count. And so they showed a continued decline in Q1 of deal count, 28% year over year, so pretty substantial. The total capital raised continued to decline at 37% year over year, tick down. So that's also pretty substantial. But the median valuations increased, suggesting that while fewer deals are being done and the total capital being raised is less, the individual deals are getting higher valuations. And I'm not totally sure why that is, and maybe you have some thoughts on that. but it kind of harkens back to this general theme that I see here, which is venture is competing more and more with public equities because the public equity markets are ripping. And when you're in the, you know, Mag 7, it's hard to beat those results. If you're up 25% year over year, 2 years in a row, it's pretty hard to argue with that. And venture can't claim that. And so the public equity markets for at least the last couple of years have really been a potent competitor for capital. And so I think there's probably a lot of angel investors, and myself included, that have deployed capital more in the public markets than they have in the private markets because of this favorable situation. So what do you think, Paul? You agree with that?
Yeah, partially. So I think the Carter data is interesting because it looks like either it's accelerating a decline recently or that the wider Carter market has a bigger decline than the Angel Group market does. It may be a little bit of both, but I think it is important to recognize that a lot of the reason there's less early stage investing is because there are fewer people doing that now. There were a lot of people investing a lot in the 2020 to 2021 period, and those have gone away. You can see that from the number of VC funds being formed in the last couple of years, as an example. So it's interesting to compare and contrast some of these data sets because they might give you a better sense of why the numbers are down. And then on your point about people deploying money into the public markets, I think you're probably right. I mean, it is hard for any asset class to compete against the premier performers from the public markets. If you put your money in Bitcoin in the last couple of years, you've done even better. So just trying to figure out where to deploy your money is obviously not easy, and doing it in short-term thinking is what a lot of people end up doing. Perhaps isn't the best idea. Having a diversified portfolio of different kinds of assets over time, different entry prices, different times, different trends is probably a sensible way to approach investing overall. But generally, you're probably right. People have been switching money out of VC and into public markets in the last couple of years.
And so what else were your takeaways on this report?
Well, there's a bunch of different topics that we could maybe dive into. Going back to your question about valuation, I think the overall question about deal structures is interesting. In this report, it's interesting to note that preferred equity remains the biggest type of deal that angels do through groups, which if you read Carter data, wouldn't necessarily be the conclusion you'd come to. There are a lot more pre-seed safes in this report, which is consistent with Carter data. But there's definitely a preference for professional angel groups to focus more on preferred equity for a whole bunch of different reasons. And even though safes are becoming more prevalent, including in geographies like the Southeast, the preference remains and most investing activity remains in preferred equity rounds for a whole bunch of reasons. So that's interesting to see that data is there and might not be something you'd expect if you were operating on your own.
It
So
seems
that's
like that the shift in favor of safes has mainly been in the pre-seed space. And from my perspective, it kind of makes sense because it's very difficult to value these pre-seed startups that have no product and have no sales. And they may have a demo product, they may have a very mature idea, they may be very connected and industry relevant founders, but it's very hard to put a valuation on a pre-seed deal. And so I think in that context, it kind of makes sense for SAFE to take up a bigger share of those financings for the pre-seed deals. But for the seed deals, SAFEs have continued to grow, but still a relatively small percentage. And do you see for the seed deals that SAFE's going to continue to make inroads, or do you think investors will resist further growth of SAFEs?
Yeah, I think probably it does make sense to price an equity around once you're big enough and the amount of money you're talking about is substantial enough to make sense to go through the headache of doing that. So I think there may be a bit more inroads that safes make in the seed arena, but that there will continue to be resistance from more sophisticated or maybe less risk tolerant investors. I'm not sure how you would phrase it, to stick to preferred equity because the rights and benefits of preferred stock, the rights of share ownership, the influence you can have as a material investor in a larger round are all bigger and hopefully generate better returns for you. So I do think there'll be continued resistance to doing everything on a safe. But you're right, in the earliest rounds, the smallest rounds, and we're talking about here the pre-seed round, which was only about 5% of what these angel groups do because it's such early deals that deals that are too early for angel groups.
Yeah.
But that does probably make sense in those earlier stages. But these larger investors are going to want to focus on preferred equity rounds.
Now, what is your perspective on the issue of board seats? Because that's clear in the funders report that angels are getting fewer board seats and fewer observer seats. And it may be because their checks are smaller, although that's speculative at this point. And so, some people like me don't want to be on boards. And a lot of that is because I'm not sure I bring value to some of these very technical companies. But the other is I don't have a big enough stake that really gives me any leverage. And so I don't want to be a tag along board member. And so what are your thoughts about this governance issue going forward?
Yep, definitely one of the trends is the number or the proportion of deals that have a board seat has fallen from 30, I think, to 26, something like that. Material change in people's appetite or ability to serve on boards. Being a constructive board member, if you want to do it, is a lot of work, but it also is a way to have a significant impact on the success or failure of that company. And so in general, we advocate for taking those board seats and trying to do the best job you can with it, admitting that it's not for everybody. It's a lot of work, often unrewarded, and you can be a detriment to the company if you're not very good at it. So definitely wouldn't say everybody has to be on a board, but in certain circumstances, it does make sense. And the ability to positively influence a company towards a positive exit is worth that effort. So we'll continue to advocate for it. It could be related to the size of deals that groups are doing. If you invest less, then you perhaps don't have quite so much leverage to say, I need to have a board seat with my investment. But hopefully the larger groups at least will be able to continue to do that and carve out the time and the member volunteers to continue to do that, because it is important. Startups do benefit from a impactful, effective board. The evidence on the exit multiples is clear on that. So if people are doing less of that, then they aren't tilting the odds in their favor of good outcomes in the end.
Yeah, I completely agree with that. I think the one thing that's really relevant here is the angel groups that have a significant number of members, like 100 or more. They can generally pull on someone in the group that has domain expertise and can really add value to an early stage company. And when companies are resisting board seats for these angel groups, they're missing out on that. The value of an investment and the leverage associated with that is relevant and it's important, but also the value add of a board member that has experience in the industry and wisdom of time is not to be underrated. And so I think that's an important thing for angel investors to consider, especially as being part of a group, because if you're a lone wolf angel, you don't have that kind of expertise to call on. Whereas if you're in a group, you do. And some of these larger groups, they always have somebody with great expertise that can add value to a startup. And so that's I think an important message for startups in terms of negotiating deals.
Yeah, no, I definitely agree. A couple of other areas that I thought were interesting. For the first time, these angel groups are doing more follow-on rounds than first-time rounds. That hasn't happened in the data set before, and I thought was actually pretty interesting overall. A lot of potential implications of that. At Venture South, we actually have done more follow-on rounds than new rounds for a while because of the way our portfolio evolves. But it's interesting to see in the market overall, that is now the balance is towards follow-on rounds on your existing deals than new ones.
Yeah, I found that interesting as well, although I have a slightly different perspective. And I would divide the follow-on round interest or momentum into two categories, into growth and desperation. So you have some startups that they're making progress, but they're not making enough progress and they're running out of money. And the idea is compelling and their momentum has been compelling, but you have to put more money into it to keep them going, as opposed to a breakout company that is approaching, you know, cash positive revenue or free cash flow positive revenue. That's much more convincing for a follow-on investment. And it's a little bit of the survival of the fittest approach, where just like in a portfolio, where do you divide your attention? Do you focus on the successful companies or do you focus on the companies that are flailing? because you usually can't resuscitate the flailing companies. And so you can make the argument that you shouldn't waste your time on them. And there may be a similar logic involved in follow-on investments where does it really make sense to keep a company alive that can't reach its goals? And I don't know the answer to that. I'm less inclined to do that personally and do fewer follow-on rounds and just stick with the clear winners.
Yeah. We probably should have another episode on follow-on round strategy and the pros and cons of doubling down on the ones that appear to be winning, or maybe the mistaken strategy of trying to keep things alive when they should be let die. It's definitely I don't know that there's a right answer. People have different opinions about what strategies make sense. But overall, it's interesting to see that now people are spending more time on follow-on rounds than they are on new deals.
It is interesting. All right, so let's talk a little bit about exits. That's what everybody's really interested in. And we've seen a dramatic fall in exits since 2021. And it's illustrated in this graphic that I hope we can show to our audience. It's a very busy graphic. It's 2016 through 2024. And the bars there basically show the return on investment, or ROI. And then it also has an additional bar for companies that exit at a multiple over 50x. And then they have the average number and then the raw actual number of exits. And you can see on the graph in the black line, the number of exits is relatively low in 2017, 15, and then it goes up pretty steadily through 2021 to 92, and then crumps down to 34 over 2 years to 2023, and now trending up. And I added a couple lines to this graph. I put a trend line in red there down the middle, which basically divides the area under the curve 50% to either side of that trend line. And then I put a dashed line, trend line at the bottom of the two troughs to kind of validate the inclination of the trend line. And so I think it kind of makes sense. And the reason I like the trend line, because it's a little bit encouraging that, yeah, there is some potential to get the exit count up to around 60 or 70 a year in looking at the total Angel Capital Association portfolio, which would reflect on individual groups, because individual groups, if you have like Venture South, if you had 5 exits in a year, that would be a blockbuster year. And that would be great, but I'd be happy with 2 or 3 as opposed to 0. Or, I'm not counting failures. That they don't count as an exit. And so I think this is a very informative graph, and it is somewhat encouraging because the trend line is up, the actual numbers are up, although modestly, and the bottom numbers are not that low relative to prior experience. So I think in terms of doomsaying, I don't think early stage venture is in a doom loop, and we've had a down cycle, but things are looking better, particularly if you look at the recycling of capital. So I talked a little bit about this last week in my commentary on the venture economy, that startups are coming out of the woodwork and they're blowing out their first day prices. And that's encouraging for the capital that is deployed in those companies that now can be recycled, because the people that are selling those shares have growth capital on their hands, maybe 5x what they had before, and they can invest that in whatever is attractive. And the Mag 7 is less attractive today than it was 2 years ago. And so maybe there's more money aiming towards private markets. I don't know, but that's kind of my thought.
Yeah. So this is actually, I think, one of the more interesting charts in the whole report, not least because finding data on exits is really hard. There aren't good sources of how do these deals actually work out there publicly. So this is one of the few insights you can get into that. I actually find this chart fairly hard to understand. So I think you did an admirable job of explaining it, although I still don't really understand how the average exit multiple of companies with a more than 50x return is 27. Some of that doesn't seem to totally make sense to me.
Well, that's not an average. That's just the group that has greater than 50.
Yeah. So 2019, that big bar there goes up to an average exit multiple of 27.3, I think. I don't really understand it. But in general, the curve of exits, there were a lot of exits in the 2021 to 22 timeframe. Those have gone away, but they've reverted to kind of historical norms. I think I get that, and that makes sense to me. The average result of those being, 40% return in the median, and I guess a 3.x ROI overall on average. Those are sort of in line with what the expectations are for the asset class. So that definitely makes sense. There is a lot of concern at the moment that there have been fewer exits than hoped. And certainly relative to the 2021 timeframe, that is true. But relative to the last 2 decades and the overall averages, maybe it's not quite as good at the moment as it has been, but it's not, noticeably different. The other interesting things are related chart a couple further on is how dominant M&A is versus IPOs. And there's also a lot of discussion about the IPO cycle and how that impacts venture. We've talked on the show a bit about the Southeast investment thesis being that M&A is the way that you get out of deals in the angel space, not IPO. And I think that the data in here suggests that that is true more generally than people think, that most of the proceeds and most of the deals are done on the M&A side rather than the IPO side. So there's a lot of things you could dig into there. I honestly am not necessarily smart enough to understand how all this data works, but I think the conclusion is it's not as bad as you might think.
Yeah, I would agree with that. It's not as bad as one might think, but it's perhaps not ideal or maybe not up to hope, but it looks like it's on the upswing from all indications. Now, one thing they didn't include on this graph and the exits graph is the IRR, which I think is half the story. So you can talk about the exit multiple, but you can't talk about that without talking about the IRR, or else you're missing half the picture. And so I'm disappointed they didn't have the data to provide information on IRR, and I think that is extremely difficult to come by. Um, and that's an area that hopefully they'll be focusing on trying to get a better number on that, because one of the real discriminators between regions in the country like the West Coast and the Southeast is the types of companies that they invest in. They generally invest in high tech companies that have rapid growth at a higher price. And then they frequently exit with very big deals, often IPOs and things like that on the West Coast. Whereas, as you mentioned, in the Southeast, we're not at all IPO focused. We're M&A focused, and the exits are smaller. But when you look at the IRR, comparing places like the West Coast or the Northeast to the Southeast, IRRs are very similar from the available information, realizing that available information is limited. And the reason they're similar is the time frames are different. So these deals on the West Coast may take 10 to 15 years to get to full fruition, whereas the deals that we're looking at and participating in the Southeast, they typically will exit around 8 or 9 years from their initial investment. And so it's a much shorter time frame. So you have a much smaller multiple, but the IRR is comparable. So I'm disappointed that they aren't able to show IRR, and I just want to make sure the audience appreciates how important that metric really is.
Got it. Yeah, it definitely is an important metric. We'll send an email to the ACA to tell them to include that next year. If they've got the ROI, that isn't a huge leap for them to figure out what the IRRs are, I would have thought. So we'll see if we can have somebody work on that. But you are absolutely right on the general importance of that metric for sure.
The other graphic I'm hoping we can show is the M&A graph, which basically shows the last 3 years, 22, 23, and 24, the liquidation versus IPO, merger and acquisition, and buyout. And as you mentioned, the M&A is by far the lion's share of exits, and no surprise there. And I love that personally as an investor. I don't want an IPO. I hate IPOs. And so I would even want to exit prior to an IPO by selling privately to avoid an IPO, because you're locked up for 6 months and all kinds of bad things happen in that 6 months. And the bankers are expert at extracting value at your expense. So yeah, that's just my opinion on that.
Yeah, no, I think that's a fair amount of skepticism on IPOs is perfectly reasonable. And then occasionally Figma comes along and you make, I don't know, whatever you make 3x in one day. So yes, but
Well,
generally
yeah,
speaking,
if you could sell that day. If you couldn't sell, you didn't make anything near that because the price went down over the following week.
well, right.
Because
Yeah.
the late insiders were able to sell and all the early insiders weren't able to sell. And I talked about this on the podcast a couple of weeks ago, that Figma deal. The bankers had reserved, I can't remember what the percentage, but it was substantial. It was like 3% of the float. And they made close to $80 million on their holdout, their, I don't know what they call it, their reserve shares that they had the option to sell. And their fee was like 8 million, but they made 10 times that with that. And so you look at that as a skeptic and say, that's an incentive for underpricing the round, because yeah, the original sellers that sold into the first public price, they left money on the table, but the bankers cashed in by running up the underbidding and then running up the price by limiting the float. So they had such a small float. And so you could make a very good case that they engineered that for their benefit.
Yeah, you want to be an investment banker, not an angel investor, that's for sure. Yep. Anything else in the report that stood out to you, David, that you thought was interesting as a super angel yourself?
Well, I would like to see the ACA seriously consider integration with some of these portfolio platforms like Carta and some of the data platforms, because there's a mutual interest there to collect data, and they have increasing difficulty getting data because data is so valuable. And the individual organizations, the data is not that useful because there's no way to benchmark that unless they contribute it to a collective analysis. And so I think there's room for the ACA to negotiate a deal with some of these platforms to get data in an automated way and in a more timely way, so they could put out these reports more frequently and more timely. So for example, in Q1, why can't they put out a Q1 report? And it doesn't have to be 50 pages. As a matter of fact, please don't make it 50 pages. Make it 5 pages and just make it 50% graphics, because, we showed what we're interested in. And I would like to see them integrate more. It's a little bit like the kerfuffle in the federal government with the Bureau of Labor Statistics, where the manager was fired, and the popular press version of that story is, oh, it's because the president wants to manipulate the data. But the reality is the data collection was so old and ill-suited to the modern era that it needed to be upgraded. There's so many sources for that data that can be automated. Why are they not collecting that data through the IRS and other avenues that collect the same data in electronic format so they can put out more accurate and more timely reports? So I would say a change of leadership made sense in that organization in order to upgrade the capability. And I'm not suggesting a change of leadership with the ACA. I'm just saying they have room to improve their data collection by modernizing the way they collect data.
Interesting. Well, we'll definitely pass that feedback along. I have some sympathy or some preference to keep the data separate, and I'll tell you why. The data we see coming out of other data providers isn't very good. And for example, if you look at PitchBook data, there's no Venture South information in that, and they give out a league table every three months about who the most active deal makers are in particular geographies, and it's just wrong. There are just far more than the deals are doing there. And it's not their fault. They're doing their best to collect the data they can. And Venture South doesn't share its data with PitchBook because we don't want to share data publicly or to people that are making money out of that data. So there's lots of structural reasons why the data isn't complete. Maybe some informal ties with some of these groups actually solves that problem. So maybe you're right. But I just like it to be clear what the data is from. And then so you can sort of haircut it or be more skeptical about it based on where it comes from. So this ACA data report is great for deals that angel groups do, but probably isn't representative of the market as a whole. And similarly, the PitchBook data is probably really good for Silicon Valley, but it's pretty hopeless for the Southeast. So you've just got to bear in mind what the data is, where it's from and how it's processed and how rigorous it is and what kind of conclusions you can draw from it. My particular hesitancy on using this ACA data is that it's great at a national level, but it doesn't actually tell me very much about deals in Raleigh or Greenville, South Carolina, because the only people submitting information in those geographies is Venture South and a couple of others, which is perhaps not a representative sample of the market in those places either. So I guess I like it to be clear what data is being used, and therefore you can be skeptical about certain conclusions because you know where it's coming from. So that would be my slight counter take to that. But I mean, in general, I agree with you. More data is good. If we can get it tied together so it all makes sense, that's probably a good idea. So maybe some slight more hesitation than you have on that.
Yeah, I wouldn't really advocate for mixing data. I was more interested in harnessing their platforms so you could collect data more efficiently and faster. So there would have to be some kind of deal because in order for them to share their platform, they would have to get something out of it. So you might have to share your data in an anonymous fashion. So you have to make a deal. But my point is that there's ways to collect this data in a much more timely way with no additional work. Matter of fact, less work, and to analyze it in a semi-automated fashion. So you could get reports on Q1 in April and much more timely data, which is really what we want because honestly, we're looking at data from 2024, which is now almost a year old. And so our markets are very dynamic. And so if we could have data from the last quarter rather than last year, it would be that much more useful.
Yeah.
So that was my only point. Now there
Yeah.
are a couple other things that I wanted to touch on, and that is the founders report or the funders report, I should say. They identified 5 trends that I think were pretty good. So hopefully we can put that up on the slide. But the 5 were basically identifying one, the sweet spot is still seed investing for angel investors. And I think that's clear from the data. A second trend was that term sheets are diversifying with more safes and convertible notes. And that's a clear trend, particularly for pre-seed investing, less so for seed investing. And then, as you mentioned, the smaller groups, individual investors write larger checks, write larger individual checks. And I think that's very interesting, particularly if you ascribe to the theory that you need to write a $300,000 check or larger in order to get a board seat. And then the fourth thing they mentioned was the board seat issue in terms of the value that angel groups bring to companies by sitting on the board and the correlation with higher returns. And so that's a very compelling data statistic that I think is worth repeating to not just investors but to founders that there's value there and you shouldn't leave that penny on the ground. You should pick it up. And then the final thing that they mentioned for trends was the M&A issue versus IPOs, which we talked about. And then I hope we can show this slide, which is a graphic from the report from 2020 through 2024, looking at the fraction of deals that represent preferred versus convertible notes versus safes and that kind of stuff. And you can see that the preferred stock is the dominant vehicle for this type of investment that we're doing, which is mainly seed investment. But the safes have encroached again, largely in the pre-seed area, and convertible notes have grown too, but fairly modestly. So still, preferred stock is the dominant form that angels like. And I think that's an important takeaway.
I definitely agree with you. Those trends are all, I think, pretty interesting. The one that I have some maybe some follow up on is the smaller groups write larger individual checks trend. That's an interesting one. So it's saying that smaller angel groups tend to write on a per investor basis a larger check than a large angel group. So Venture South is a large angel group. On a per member basis, we invest less than a 50-person angel group would. And that's interesting. I don't know if that's good or bad or what, or whether Venture South should maybe try to purge some of our less active investors so that we increase our per member investment rate a bit. I don't know what the
Call the
conclusion from that
herd.
is. Yeah, right. I mean, I'm not sure whether we want to compete on that statistic or not. I actually like the fact that we have some members that don't invest very much because they're starting out, and that might be easy to do if you're part of a big group. So I think there's some interesting structural things there to think about, whether or not you, and maybe as an individual angel investor, it might be interesting to think about whether you want to join a smaller group and therefore be kind of required to write a bigger check or join a bigger group and maybe not. There's some interesting dynamics there to think about that I admit, fully digested yet, but I thought it was an interesting trend that they identified and one that I'm going to think about as an age group operator a bit harder. But on the other ones, I think all of those trends are ones that we've talked about and I think are true. And as an individual investor, you want to pay attention to those things and tailor your investing activity accordingly.
Yeah, I would agree with all that. One other thing that was interesting in the Angel Funders report was they talked a little bit about this spinoff group from Tech Coast Angels that they basically are a subgroup or a separate group that's smaller, and they tend to write bigger checks from what I can see. And it seems to be a group that's perhaps more devoted to full-time angel investing. And it's very interesting concentration strategy in terms of trying to get big check writers together, working together and writing bigger checks for more influence and piggybacking on top of a larger organization like TCA for deal flow. The one flaw that I saw in that strategy was this collective voting on deals, which I think is, problematic because it basically creates an environment where the lowest common denominator can veto deals. Even if you require just a majority, there's still a significant number of people that can veto deals. That, in my view, the better way to approach that is if you want to invest in a deal, you individually make that decision. And the group's role is to bring deal flow and manage diligence and deals and let the individual decide. Otherwise, it's a fund. And there's nothing bad about that. A fund, and matter of fact, a fund is very efficient. But I think that's the reason why a lot of funds are struggling now is because angel investors want to make their own decisions. And I think you have to recognize that. And so if you want to create a focused a group that's focused on bigger checks, bigger deals, and having board seats and those kinds of things, I think it's better to say, okay, well, let's have a threshold, say 300,000, where if we can't get enough interest to invest 300,000, we're not going to invest as a group. You can invest individually. And then if you do reach that threshold, then you write a check for 3, 4, 5, 600,000, and then you have greater influence, better probability of getting a board seat, and you have members that are more committed because part of the deal with these focused groups is that you're spending more time on the group, you invest more. That's a big part of your investing activity. Like for me, that's what I do full time. And so it's attractive from that perspective. But I think you need to avoid this flaw of groupthink where you have a vote on whether you should invest in something. I think you put your dollars where your mouth is.
Interesting. Yeah. Definitely appreciate the concern about groupthink and herding the cats, and particularly when you have to get to voting thresholds and that kind of stuff, it can be very hard to operate those kinds of group-directed funds. That's why there aren't that many of them around anymore. There are a couple in the Southeast that still use that model, but not many. The flexibility of picking your own deals is important. The automatic diversification of a fund under the direction of a fund manager is also an interesting model. So I guess you have to try to figure out what your personal balance between autonomy and check size and diversification is, and try to find an avenue that best fits you. I don't know that the Angel Funders report necessarily helps you figure that out, but I guess it does show you there's some options out there that you can go after if you want to evaluate what the best method is for you.
Yeah, it's more information from a unique source that you can't get from any other source. And so I think it really adds to our data set in a very significant way. So I find it very valuable. There's always room for improvement. So that's pretty much all I had to say. Did you have anything else to talk about, Paul?
No, that's great. We'll put the link to the report in the show notes so people can see it. As a quick Venture South plug, we are number 8 in the country, which we're always happy to see that we are one of the top 10 angel groups in the country. So we will blow our own trumpet a little bit on social media to publicize that. But there are a lot of good angel groups out there, so we're happy to share our data with that collective set to try to make us all smarter and make better investments. I definitely encourage people to go read the report, and happy to argue with people about it as we go forward.
All right. Thank you, Paul.
Thank you for listening. Visit us at ventureinthesouth.com for a complete list of previous and future shows.